I'm Jesse Mackey, CIO of 4Thought Financial Group, and this is 4Thought's weekly market perspective for the week of June 9th, 2020. Stocks continued to move aggressively back towards their previous record levels during the last week, in a continuation of the sustained recovery that has followed the dive into a bear market during late February and most of March. The most recent low point for the S&P 500 index of U.S. large-cap stocks was on March 23rd, at which point it had dropped more than 34% from the record peak achieved on February 19th. Despite crossing into positive territory for the year-to-date 2020 yesterday, on June 8th, it still remained 4.75% below its record peak as of the close of business. Historical market type statistical analysis reveals that once a bear market is confirmed, which occurred on March 11th, the average time to the trough of the cycle is approximately 5 to 6 months later. The average additional loss is approximately 16.72% from the bear confirmation point, although both the actual time to trough and the additional cumulative loss vary widely depending on the specific time period referenced. For long-term investors, this window has historically proven a very opportune time to deploy any excess cash accumulated in bank checking and savings accounts that's not needed for short-term expenses or savings goals, or to supplement household living expenses in the event of a temporary loss of earned income. Given the already elapsed time since confirmation of the most recent bear market, any cash deployment should take the form of an immediate initial lump sum injection of 80% of the investable cash, with the remainder dollar cost averaged in at 10% increments over the next 2 months. Long-term investors should speak to their advisors regarding whether and how to implement this, based on their particular financial situation. From a probabilistic analysis perspective, stock types range from near fair value, such as with mid and small cap stocks, to moderately overvalued in the case of large cap growth stocks. Bond types also range from near fair value in the case of emerging markets bonds to moderately overvalued in the case of long-term U.S. Treasury bonds and investment-grade corporate bonds. Against this backdrop, the outlook for stocks is now modestly positive in the intermediate term based on the overall aggregate of our historical market type data analysis and quantitative probabilistic analysis. U.S. aggregate bonds are still the strongest performers so far in 2020, while U.S. small cap stocks and global private equity show the worst year-to-date performance. Emerging markets bonds now reflect the most attractive pricing relative to the alternatives, while growth stocks are the least attractive. With regards to allocations amongst investment methods, we're now allowing overweight allocations to strategic asset allocation, neutral allocations to liability-driven investing, and underweights to selective concentrated investing and opportunistic investing. I hope this was helpful. If you have questions or you'd like to discuss how to implement any of this, please contact 4Thought at 516-300-1617 or at info@4tfg.com. And don't forget to subscribe to our blog feed and to our YouTube channel. Thanks for watching, and see you next week.